Thank you for joining us today. If you found this from our email newsletter, you probably saw that we introduced this webinar with title, something along the lines of the incoming tidal wave of private investments that you're about to hear about. This is a topic that we think will be a big part of just the sales that you receive from other financial advisors or investment companies. And we want to make sure that you feel knowledgeable enough just to kind of understand what they are, some of the pros and cons about these investments, and, maybe spoiler alert here, why we're not going to be recommending them to you right now. So first of all, just what do we mean by private investments? This can mean a lot of different things. There's no real one definition here. It's also confusing because they can be called by a lot of different names. For example, like alts or alternative investments is another term that means just about the same thing as private investments. And this can be a lot of different types. This list is not comprehensive, but is a good start for the majority of things that are out there. There's a few on this list that we're not going to spend a lot of time covering today, like commodities, hedge funds, venture capital, and certain REITs or real estate investment trusts. Just don't really have a lot of time. These have also been out there already for a really long time. Where we're going to spend our time and energy today is looking at these bottom two, private equity and private credit. And if you're not familiar with these two terms, don't worry. It's actually a really simple concept. Private equity just means buying stock in a company, but these are not companies whose shares are publicly traded. So we're not talking about Microsoft or Nvidia here. You can't log into your Charles Schwab account and buy shares of these companies. And private credit is the same idea. It's just debt or loans instead of stock. So once again, you're probably familiar with bonds, treasury bonds or corporate bonds that you can buy in your IRA or brokerage account. These are not like those at all. You cannot just easily go in and buy these anywhere. They're not going to be in any of the ETFs or mutual funds that you own, though. As we'll look, they're starting to pop up in some very niche funds that are out there. The word private really just refers to the fact that you generally need to use some very special types of funds to be able to have access to these investments. But that's changing now. One big barrier to investors purchasing these types of investments has been that you had to be what's called an accredited investor to be able to just put your money in funds that buy these investments. And this means that you have to have a certain amount of investable assets or high enough income where they deem you can take the risk to make these investments. But there has been legislation out there recently to change that and make these types of investments available to nearly anyone. That there's some thought that this type of a bill is much more likely to pass now with the recent election. And even if that accredited investor rule doesn't change, there are many offerings out there that are marketed to ordinary investors. Some of this is because of loosening regulation out there. Some of it is because fund companies are getting a little more creative. And this means that these private investments are now showing up in some ETFs, mutual funds, and other investments that you probably have access to today. And these companies have some very serious money to spend on advertising. And whether it's because of the huge commissions that they pay or the high expenses that they charge, it's likely you will soon be bombarded by salesmen and advertisements touting some of these great sounding benefits. And it's really the same things you see about any investment, really lower volatility, diversification, and the chance for higher returns. And so we're going to go through these and explain why we think you should not believe the hype. And starting with lower volatility. The claim here is just that these investments don't go up and down as much as other investments. No one likes seeing their stocks fall, 40% in a few weeks during the COVID crisis, right? And how much better would an investment be if it had the same returns but didn't go up and down as much? Everyone would like that, of course. And you'll find this claim on just about every single private equity fund out there. But there's a really big caveat to this claim. And it's really that this exists not because of the characteristics of the assets per se, but more so because of the fact that these private investments just rarely trade at all. And remember, these are not shares of companies that you can buy in Schwab or Vanguard or Fidelity. Very few people are out there buying and selling these types of investments. And it's not uncommon for these to never trade in a given year, even. And so if the COVID crisis occurs again and the stock market falls, 40% in a couple weeks, then very quickly rebounds, all before a private investment trades again, it will look like the value of that private investment never really went down, just kind of stayed the same. But, and just like magic, they can kind of say, hey, there was no volatility here. But I think common sense kind of tells you that that wasn't really the case. Just because these funds didn't trade does not mean that their value didn't change. And there are times that these investments can be revalued based on other circumstances. Funds can adjust the value of their holdings here, but they have a lot of flexibility in how they can do that. And this creates some really strange price movements. For example, on the right here is a table from a recent Wall Street Journal article kind of highlighting this weird feature of these funds. And in this case, we're looking at funds that increased a very significant amount in one single day. And for example, look at the top of this list here, the CDH Fund 4. In a single day, that fund revalued its holdings and booked a 1,041% gain in a single day. And, so do you really think there was not a day in between these two prices when this fund was up, say, 100% or 200%? Of course there was, but it's just the fact that these do not trade, these prices do not update every day. So you get these really dramatic swings when a price change finally happens. You also get many, many days where prices don't change and they look very steady or not volatile investments. And this is an example of funds, rising in value, but funds also have the flexibility in not immediately reporting assets that have declined in value. And that's kind of the problem here, more so than big gains, right? No fund wants to show a drop in value. And so even though their investments may have, there may be some evidence that they've fallen in value, if they don't update it, it looks like it never happened, right? And so they're incentivized to kind of not update these prices very often. And that leads to something called volatility washing. And I won't go into the details here, but there's some evidence out there that this claim of lower volatility is really just a result of flexible accounting rather than the investments. And, as some research has called it, the diversification illusion. Just that these funds don't provide the value that they kind of claim that they do. And just to show an example of this, I wanted to look at the S&P 500. This is the most well-known stock index out there. Most people probably familiar with it. And this is a chart of the S&P 500 over the last 20 years. We all know that stocks have been volatile. This chart pretty clearly shows 2008, which was a very dramatic decline in the market. 2020 COVID crisis, 2022, kind of the recent bout from inflation. And so remember the shape of this chart. This is what we're used to with the volatility of just regular stocks here. And here's that same chart if the S&P 500 only traded on January 1st of every year, except for January 1st of 2009. I took that out just kind of to prove a point here. But this chart looks much more stable, much less volatile, right? Hardly any big dips at all, nice steady increases, just what you would probably want in an investment. But of course, if you were actually invested in the S&P 500, it did not feel like this, right? We had at least three very big, kind of shocks to the system that had very big declines here. But this is kind of the type of manipulation that you see with these private investments. Is volatility really lower? I would argue not. Just because you don't report a new price every day does not mean that, magically all the volatility has disappeared. But of course, that's not what salespeople will show you. They'll show you a low standard deviation, a high Sharpe ratio, something else to prove that these investments are in some way superior to what you can buy in a brokerage fund. And this is just our way of saying, kind of, be cautious, maybe don't fall for that claim on its own. The next big claim that you'll see here is that these funds help you diversify. They'll say that there's, great value in being able to invest in thousands of more companies. By some estimates that I saw, there's about 5 times the number of private companies with $100 million in revenue as there are public ones. And so, regular listeners here know that we've always touted the benefits and the importance of diversification. So, why is that the case now? Why are we, not advising you to rush in and invest in this huge pool of companies that are out there? And, there's one point here that many of these companies are very small, and I think you could and maybe should argue that they probably should not serve the role of, protecting your retirement assets. And to show you just how small many of these companies are, I was going to look at this chart from Vanguard here, and the green lines here represent the assets in all the private equity funds that are out there. And just, kind of jumping to the latest data point they have, shows about $6 trillion in private equity funds. And 6 trillion seems like a big number, right? Why would you not want to invest in a $6 trillion market out there? Well, it turns out when we're talking about the whole world of investable assets, 6 trillion is actually pretty small. Just the publicly traded stocks that are available around the world have a value somewhere of about 110 trillion. The public bond market is even larger, about 130 trillion. And these numbers are estimates. It's very hard to get an exact number, obviously, but they are, somewhat right within an order of magnitude here. And you can see that publicly traded investments total somewhere north of $200 trillion. And so that's 200 trillion of assets that you can buy today in your IRA or brokerage account. Having this new pool of $6 trillion in money is just really not that significant, certainly not as significant as they make it seem. And just to show this another way, I wanted to show you the exact number of companies that you can invest in very easily with a very, very basic four fund Vanguard portfolio. And so this doesn't just apply to Vanguard, by the way, really any of the big index funds will have similar numbers to this. But here I'm just showing four ticker symbols. This is four separate Vanguard ETFs that are out there today. VOO is a large cap. VXF is a US kind of extended market fund. VEA and VWO are international stocks. And if you just buy these four funds, you would effectively be investing in about 13,745 companies. And this can all be done for a fee of about 0.05%. Remember that here in a few slides, we're going to look at the average fee for some of these private investments. And the point we're trying to make with these last couple slides is that the public markets are more than enough to keep you diversified. It's a much bigger pool of assets. It's many, many thousands of companies that you can invest in. And do not feel like you're missing out or not diversified because you're not using some of these private investments that are being sold out there today. And then finally, perhaps one of the most important investors would care about, returns. And so it's worth pointing out here that private investments are really popular now because someone named David Swensen, he managed the endowment of Yale University starting in 1985. And he had a period of just really phenomenal returns. And he broke the mold, at the time and used a lot of these private investments in Yale's endowment. He did very well, but remember, this was 40 years ago. He was well ahead of the curve here. Over the next couple decades, everyone saw what he was doing and they wanted to join in, right? And just like many other examples of investors chasing returns, it just has not worked out so well for those that are jumping into this more recently. David Swenson was very smart, very wise to see this opportunity 40 years ago. It's a very different world today than it was 40 years ago. I found this paper cited in a Wall Street Journal article. It studies the returns of Ivy League school endowments, and it has found a pretty significant underperformance of these Ivy League endowments compared to just a very basic index investing strategy. In total, it found their underperformance averaged about 20% over the last 16 years. And so you should know it is not like everyone is out there making boatloads of money here in private investments. And in fact, it's like just about any other group of investors. There are a few that are doing well, but many, many are not. And so that's kind of our rebuttal for the supposed benefits of private investments. Every sales page for funds for these types of investments are going to go through those 3 points. And hopefully, this helps you just kind of see the other side of the story and know that these are not these new special type of investment out there that you should feel like you really have to jump into. There's a few other things we want you to know about these investments as well. First and foremost, these types of investments have really, really high fees attached to them. This chart on the left shows the average annual fees of private credit funds in the dark green here, and the light green is the average high yield bond ETF. So the light green is funds very easily for you to buy, in a Schwab, Vanguard, or Fidelity account. These dark green bars represent the fees for these private credit funds. You can see much, much higher. And in fact, the average fund, in 2023 had an expense over 4%. So that 4.12% average fee. For $1 million investment, that means an annual fee of $41,200. Remember, I had said before that simple Vanguard portfolio had a 0.05% fee. That would be a $500 fee for $1 million portfolio. And so we're talking tens of thousands of dollars in added fees for an investor to access these funds. And this is just a huge hurdle for these funds to actually end up delivering good returns for their investors. They have to outperform by 4% just to break even, and that's really hard to do. On the right here, I just wanted to show you how crazy some of these fees can get while looking through funds for this webinar. I found this fund out there with, you can see here, an annual fee of nearly 10%. So that would be a $100,000 annual fee and fund expenses for $1 million portfolio. And so these fees just get really crazy. You should at minimum, know the fees if you're looking at any of these types of investments and make sure it actually makes sense to pay $100,000 a year for your $1 million investment. We would argue it does not. And then another really important thing to be aware of in these types of investments is that they are very illiquid. Remember, I said before that many of these investments rarely trade. And so when funds buy these investments, they can't always sell them if their investors want their money back. And so this top headline here is from one of the more famous private real estate funds from BlackRock a couple of years ago. Investors decided that they wanted out, and the fund just simply could not raise the money to get investors their money back. They locked down the fund, and ultimately, investors were limited to taking, I believe, only 0.3% of their money out per month. So just, to say that another way, it would take about 25 years to get your money out of that fund at that rate. So you need to know that these funds can restrict you from getting your money back if times are bad. And that means when things go bad, you will very likely be forced to just buy and hold these investments. And then very recently, these types of investments are also showing up in ETFs as well. So this bottom image is from a brand new ETF that's out there. The ticker symbol is XOVR. And you'll notice that the top holding of this fund is stock in or private equity in SpaceX. It makes up about 10% of this ETF. And so ETFs are very popular because you can buy and sell them regularly during the day, but there's some question out there about what happens to these types of funds when they hold very illiquid assets. And so if this fund were to have to sell a lot of its assets to meet redemptions from big investors, it probably could not sell the SpaceX stock very quickly. It would have to sell all their other holdings here. That could compound some problems because now SpaceX is going to become a larger and larger percent of the fund. And as far as I know, there's no real precedence here in how something like this would play out in a really bad market environment. This is kind of new for ETFs, again, with some loosening regulation on the SEC allowing some of this stuff. And just personally, I don't know if I would want to be on the ride to find out what happens to a fund like this in a very bad market year. And again, we're talking about preserving your retirement savings here. These types of funds, I think, are potentially dangerous. And so to end this webinar, I just want to come back to the question that we started with: why now? Why are these investments all of a sudden being marketed to you? These fund companies are not doing it out of the kindness of their hearts because they've felt bad that we couldn't buy these investments years ago. They're doing it for a couple reasons. One, they are doing it because they can charge large fees. We looked at the fees before. They're orders of magnitude higher than what you can get with a basic ETF. Fund companies like charging higher fees. And also, many big investors and big funds out there need liquidity. There's just not enough institutional investors anymore putting money into these funds. So the next group to reach out to is the ordinary investor. And so I think you should ask yourself here, if current investors want out or at least don't want in anymore, why should you want into these types of investments? And then finally, this is just a really opaque part of the investment world right now. Regulation's pretty thin, conflicts of interest are really high. There's a lot of questionable characters and companies out there pitching this stuff. And so I thought this quote from a Jason Zweig article in the Wall Street Journal recently summed it up really perfectly. He was warning readers about these types of investments. Started with this type of a quote here: financial advisors might tell you that you need to buy alternative assets because public stocks and bonds are overpriced, maybe doomed to provide years of poor returns. What they won't tell you is that they need to sell you these alternative assets because otherwise their own firms will have to hold them and be doomed for years of poor returns themselves. And so I think that sums up really nicely just what you should consider before putting some of your money into these types of investments. Again, it's a complex topic that we're trying to go through relatively quickly here. So if you have questions, please let us know. You can kind of type in the comments here in YouTube, or simply send us an email. We're happy to meet and talk about this in more detail if you'd like. But if there's no other questions here, happy Friday and have a great weekend. Thank you.